think about this really quick. If you are out there loaning out money to somebody and there's a payment that you are demanding that that person pays you back each month until they pay off the loan, you want to know how are they going to pay it back. Of course, let's say they have the history of borrowing money, but you want to know how much money are you making. So today we're going to talk about how to calculate income, how income is calculated to qualify for a mortgage. Before the bank loans you all this money, they know, okay, if you want to borrow X amount of dollars over 30 years, 25 years, 20 years, 15 years, they do a math, they see the payment. This person needs to make X amount. And how do they know? They'll calculate your income. So it's how they calculate your income. So they calculate your income different ways. And we're going to go over it tonight on how they're going to calculate your income, how income is calculated. Remember, there's income called as is income. So whatever your income states as is, they will give you that income to qualify for a home. Also, there's gross up income. Some incomes, they'll allow you to gross it up. Gross down income. Some incomes you're receiving, but they're going to gross it down. Some income they're going to average over 12 months. Some income they're going to average over 24 months. Some income, because you just got the job, they're going to give you a year to date. They're going to give you the year to date, maybe because you don't have a 12-month history or a 24-month history. Also, worst case scenario. Let's say your income is declining so much. They're going to go off a worst case scenario, which means they're going to take the worst month, year, and divide it by 12. They're going to go off the worst case, or they'll cut your overtime and bonus and just let you use your base income, worst case. So let's get into fixed income. So fixed income, there's two types of fixed income. There is taxable income and there's non-taxable income. If it's taxable income, it can be court order, government order. The bank's going to send you a reward letter, court order document, retirement, whatever your distribution on your retirement or on your tax return. They're going to give you as is income on fixed income. If your income is fixed and it's taxable, whatever the document says, whatever is proof on your bank statement, whatever proofs on your tax return, they're going to give you as is. So if it's taxable, it's as is. If it's non-taxable, they allow you to gross up the income. Remember, you have to prove that you're going to get it for 3 more years, but if you can prove it and you're consistently getting the dollar amount and you're going to get it for 3 more years, they'll allow you to gross it up on non-taxable income. They gross up between 15 to 25%, depending on the program. For example, if you go with a conventional loan and you're receiving $2,500 a month as your fixed non-taxable income, they're going to gross it up to $2,875 on your loan application for you to qualify. You're going with a government loan, USDA, VA, FHA, they're going to gross it up 25%. So on $2,500, you're going to get $3,125 to qualify. That's what they're going to put on your application. Some of you guys, you might look at your application, whoa, I don't make that. Remember, they're going to be able to gross it up. So if it's fixed income, it's taxable, as is. Non-taxable, they're going to gross it up. That's how the banks calculate fixed income. If you have fixed income questions, please message us, right? info@whatsamortgage.com, right? If you like, hey, I don't know if I can use this income, it's fixed, message us, right? info@whatsamortgage.com, or give us a call or text us, 714-790-9697. So now that we talked about fixed income, let's talk about rental income. So rental income, let's get back to rental income. Remember, there's new rentals and vacating rent, right? So if you're buying your first rental property, you can use 75% of the gross rent. If you are vacating a property, you can use 75% of the gross rent. So if you're receiving $4,000 a month, or you will be receiving $4,000 a month, you can use $3,000 a month to help you qualify, 75%. But if you own a house, you're buying a house owner occupied, you cannot use rental income unless you're doing a 2-unit, a 3-unit, or a 4-unit. You can't use that border rent. Like I said, you have to show it on your tax returns. So if you are buying a home and using rental property, rental income, new properties, you can use 75% of the gross rent. You're going to gross it down. Same thing with vacating, right? 75%. But if you have a rental property already, it is existing rental, they're going to take the average. The lenders are going to look at your tax returns. So if you write off everything, you have no income. So when you look at your tax return, it's not the amount you receive, it's your net rent income. And they're going to average it out over 1 year or 2 years, depending on how long you've had your rental property for. They're going to look at your Schedule E. And in some cases, let's say you claim a negative. All of us, you can talk to some lenders, they'll use the 75% of the fair market rent. Like it says the same rule. Let's say you collect $4,000, they'll let you use $3,000. They'll look up the fair market rent. It all depends on the lender you use. Some lenders, they find a way to finagle it. The way they talk to the underwriter, hey, this person, for some reason, now they're renting out to a new tenant and they're collecting more in rent. So let me use a 75% market rent, not the rent on their tax return. So when you do have rentals, you want to let your lender know right away. You want to have your Schedule E ready, and you want to know what the fair market rent is, because there's different things lenders can use to help you qualify. So of course, that right there is rental income, how they use to qualify you. The third one is self-employed income. So if you're self-employed, typically, like I said, if you're self-employed, they want a 2-year history. So the 2-year history, they're going to do a 2-year average. That applies to jumbo loans, government loans, right? Jumbo loans, government loans, and conventional loans. Remember that they want a 2-year history. So there's a 2-year average. So you're going to look at your tax returns. They're going to see what your net income is. They're going to add back depreciation. If you file a sole proprietorship, they're going to add back business miles, and they're going to qualify you. There is a workaround, the 1-year average workaround, the loophole. If you are going with conventional, so not on government loans, not on jumbo loans, you could use a 1-year tax returns. For conventional loans, if you're putting 5 to 10% down, you have above a 700 credit score. But remember, this is not a work history. This is just the way you file your tax returns. You can go 1-year tax returns, but the company has to be around for at least 5 years or more, or you have to be self-employed 5 years or longer. So if you're that person that shuts down your business every year to change names because you have a different idea, but you've been self-employed, they'll go off of 1-year tax returns if your CPA is willing to write a letter that says that you have been self-employed for over 5 years. That is the only workaround I know for 1 year. But if you are self-employed and you write off everything, you don't show a cent and you're negative, guess what? If you didn't pay Uncle Sam, now you got to pay a higher interest rate. You can get something, a non-qualified mortgage. If you're buying a rental property, if it rents positive, as long as the down payment is big enough, they'll let you use that. You don't file any income, or they'll go off of asset depletion, or they'll go off of 24-month bank statements. So if you're self-employed and you don't show any income, you might have to go with a non-qualified mortgage. So that's how self-employed income is calculated for you to qualify to buy. Now, last but not least, like I said, our favorite, our most popular, W-2 income, wage earner income. So wage earner, if you're a W-2, and you're hourly or salary, there's different types of W-2, right? Let's go off of hourly or salary first. They're going to give you as is. So if you make X amount, they're not going to average it out for 2 years. Let's say you make X amount and all of a sudden you get a pay increase. After 30 days, you can use the higher base to qualify. Let's say you're at 25 bucks an hour for like 10 years. All of a sudden, you're at $30 an hour. After 30 days, they'll let you use that 30. It's as is income. Same thing. If you have a 2-year work history, but you change jobs, same line of work or same industry or same position, and you take a new job, after 30 days, you can use the new pay. It's as is income. So after 30 days, you can use the new base pay, not overtime or bonus. That's different. The base pay income. Now let's talk about overtime or bonus. Let's say you did change jobs. As long as you have a 2-year history of overtime or bonus, they'll let you use a new one, but they're going to go off the year to date, maybe 12-month average. But if you've been there for over 2 years, a 24-month average of overtime and bonus. If you work part-time, it's okay. You can still buy a home with part-time. It depends how much you make part-time, but they're going to do a 2-year average. That's when they don't give you as is. If it deviates from the 40 hours a week from your part-time, then you can't, well, this week I work 40 hours. No. When they send a letter to your employer, a VOE to fill out, and it says part-time, even though you work the 40 hours, they're going to average out the income. If you work seasonal, you need a 2-year average as well. If you are commission, you for sure need a 2-year average. If it's a job change, but you were commissioned before, they can take a 12-month average. If you've been there for 24 months, 24-month average. Let's say you just took a job and you're a commission. If, let's say you were selling cars, you've been selling cars for 10 years. You took a new job. You've been there 3-4 months. They're going to average that out. Let's say, oh, well, it takes a while to turn your pipe as being a car salesman or any sales job. If you buy a home too quick, they're going to take the year to date. Your old job might show all this income, but your new job, they'll still let you use the commission, but they're going to take a year to date. So you want to be deeper into the year unless you can get your pipe to turn fast enough. So that right there is how lenders look at wage earner. For salary and hourly, they're going to give you as is. If you're using overtime, bonus, part-time, seasonal, or commission, they're going to either take a 12-month average, a 24-month average, mostly 24 months, especially when it comes to seasonal, part-time, and commission. Rarely will I see a year-to-date on seasonal or part-time or commission. Normally, they'll want a 12-month average, even though it's possible, but depending on the lender, depending on how they paint that story. But I do get asked a lot. Common W-2 dilemmas people run into. Salary and hourly commission. I see a lot of people, they have these high-paying hourly or salary jobs. They take a pay cut to make more on commission. Now, their salary got cut, but they make more commission. They're even at the same company. But if the commission is over 25% of your income, they're going to want you to wait at least 2 years. Happens to a lot of people, so common. Let's say you were working at a car dealership as a mechanic, and now you're doing sales. You took a lower base pay cut, but you're making more commission. That commission is over 25%. They're going to want you to wait 2 years. Overtime or bonus, that's less than 2 years. I see people, They work at a job and they take this new job, and their new job has a ridiculous base and they're working overtime. They've been doing it for like a year and 8 months. Guess what? They want to see a 2-year history of overtime. Another one that happens, especially right now during pandemic, gap in employment. If you are a wage earner, you cannot have more than a 6-month gap of employment. If you do, they're going to want you to be at your job for at least 1 year with that gap of employment, unless it's pandemic, unless you were sick somehow where you can't work and you have proof of it. They're going to want 1 year. If not, if it's more than 6 months, they'll let you buy after 30 days as long as it's hourly or base. But because of pandemic or because you were sick, there has to be something crazy to not make you wait 12 months. Seasonal, you gotta wait 2 years. You can't get around 2 years on seasonal. Second job, all of a sudden you want to buy a house. You start working at DoorDash or Postmates or Uber. If you haven't had both jobs for 2 years without a gap, you cannot use that income. See it happen all the time. Oh, I've been here for a while now. I can't. You need 2-year history and there's no gap. So if you have the second job, let's say you're a security guard, part-time, but you quit or they laid you off and you have a 1-month gap to get to your other job, guess what? You won't be able to use that income until you have a 2-year history without a gap. Another one for my nurses and people who work for the union, you are salary and hourly, and all of a sudden they change you to per diem or stipend. If they change, even though the dollar amount might be identical when you were hourly or salary, they want you to wait 2 years. Those right there are the most common W-2 dilemmas that pop up. Now you have the keys to the kingdom. Now you know how the lenders are going to view your income when they're calculating what income they're going to use to qualify you. Qualified income, I say, is one of the main pitfalls, not the only, but a main pitfall that cause people not to get approved or fall out of escrow. If you know how to review your income, also how to talk to your lender about your income, you are going to set yourself up for success. So that right there is how the lenders calculate your income to qualify to buy a home. Guys, if this brought you value, do me a huge favor again, save this video, share this video, and like it. And by now, if you're not following us, do me a huge favor, hit that subscribe or notification button so you're notified every time we go live or post new content. All right, guys? So thank you so much for watching. If you do have mortgage questions, bring them on. Like I said, I appreciate everyone who watches this channel. Like I said, we want to end all our live stream with our attitude is gratitude. Without all of you, there would be none of us. So thank you so much. Have a great night.